Good morning or good afternoon, everybody. So it's now time to open this webinar. So thank you very much to all of you for attending this fourth webinar of AI and Finance Monday, entitled AI Regulation in the Financial Sector, Cross Perspectives in Asia and Europe. This series of webinars is organized by the XAI for Anti-Money Laundering and Digital Finance chairs within the Operational AI Ethics Initiative of Télécom Paris. In these four seminars with ACPR, we will have a broad international look at the regulation of artificial intelligence in the financial sector. And in the past few weeks, we have been busy with news regarding AI regulation. The European Commission unveiled a new proposal to regulate the use of AI, containing requirements, in particular for high-risk application. They are catching up with the leading group of national authorities, which have previously issued guidance on AI. And today we have gathered leading experts and scholars who will help us unpack these recent events and explore their implications for the financial sector. More broadly, we will discuss the risks and benefits of different approaches to regulation of AI around the world, thanks to our panel of international experts. So I'm David Bouni. I'm professor of economics at the Department of Economics and Social Sciences at Télécom Paris, Institut Polytechnique de Paris. And I will have the pleasure to animate this webinar with Olivier Fliche. Olivier, if you want to.
Yes, thank you, David. So my name is Olivier Fliche. I'm from the French Supervisory Authority, the ACPR, and head of the Fintech-Innovation Hub. So we are partners with Télécom Paris for this series of webinars. This is the fourth, as David mentioned it. This is the fourth edition of these webinars. We have already addressed explainability of AI, biases and fairness of AI and data sharing issues. And today we wanted to cross different perspectives. First, on AI regulation in the financial sector. So the first crossing of perspective is, of course, the usual one in these webinars, which are having regulatory perspective and an academic perspective. So that's why we invited two representatives of regulators and two representatives of the academic world. And the second crossing of perspective was Asia and Europe, which are two areas in the world where many things are happening in the field of AI. So of course, the news are rich, as mentioned David. So of course we've got in Europe the recent publication of the AI package, and that's why we invited Jan Sessens, head of the Digital Finance Unit at the European Commission, to speak about this package and to explain us about the European approach to AI in finance. So I would like to thank him for being present today. And for Asia, we have invited Xushin Lee. So thank you, Xushin, to be here today. Head of the AI Development Office at the Monetary Authority of Singapore. And as you may know, the Monetary Authority of Singapore has published recently the conclusion of their phase one of the Veritas project, which deals with implementing the principle that they published in 2018. So it will be very interesting to have this experience of the first experience on implementation on AI principles. And from the academic side, we have invited two professors of law. John Armour, Professor of Law and Finance at the University of Oxford, and correct me if I'm wrong, John, you are specialists of corporate governance, and you will have this perspective and this approach of aligning production regulation and corporate governance in finance. And Douglas Arner, Professor of Law at the University of Hong Kong. Douglas, you have written a number of papers on regulating AI in finance, so you will speak about this and about balancing risk and opportunities. So thank you for your presence today. And I suggest maybe we start, except if David, maybe you will want to add a few words on how things are going to be organized today about the Discord link.
Yes.
I pass you the floor, and then we will start with the presentation.
Okay, thank you very much, Olivier. Yes, so you can, for all the participants, you can ask questions in the chat, and also we have open a Discord link. Stefan, if you can, yeah, thank you very much. So, no, okay, it's perfect. So you can ask questions and chat with the speakers, and here is the link on Discord. So, okay, perfect, Stefan. Thank you very much. So the link is open during 48 hours today, so you can ask and still continue to ask questions and chat with the speakers. So thank you very much again for all the people here, and I would like also to say that we prepared this this webinar with Winston Maxwell from Télécom Paris, and Winston could not join us today, but so I say him hello because I'm sure that he will watch this video in a few days. So thank you, Winston. So we can open the webinar and give the floor to John for the first. It's Yen. Yeah. To this first presentation. So Yen, if you want to. Yeah. Perfect.
Yes. Good morning, and thank you very much indeed for setting up this very interesting exchange and webinar. Can you hear me first of all to make sure that's the case?
Yeah, we can hear you.
Very good. That's very good. I have prepared just a couple of slides, actually, from the European Commission's perspective. So I will try to actually to share them now with you. And
okay, perfect. So
very good. You can see them.
Slides. Yeah, perfect.
It's even better. I'm still trying actually. Voila. Okay. So indeed, no, thank. I will kick off the discussion with some considerations indeed on the European approach, or the European Commission's approach actually on artificial intelligence in finance, and I'll make this presentation actually referring both indeed to a bit more cross-sectoral approach, but then also indeed to some specificities of AI in finance. So I'm trying to move to the next slide, but it doesn't seem to work. I'm sorry about that. I'll try it a little more then.
Maybe you can enlarge the slides, or
I tried that, but doesn't. Okay, sorry. This seems to be my computer with having a problem. Okay, so now it is less nice now, but I can now move actually the slides. If you can still see them, then I will continue like this actually.
It's
okay like this?
Yeah, it's okay.
Thank you very much indeed. So what's the context of the European Commission's policy on this? It's indeed that making Europe fit for the digital age is one of the key priorities of this Commission of President von der Leyen, who really made it a strong priority of hers to make sure that Europe actually leads the way on digital, or otherwise it will have to follow the way of others who would be setting the standards for us. And in the financial sector, indeed, we set out in a strategy last year, actually after a broad consultation with stakeholders, how we see actually the vision for Europe on digital finance. Which is indeed, of course, a particular area of the digital development with some specificities, indeed, where we think that Europe should have a role to actually drive digital finance with strong European market players in the lead. But very importantly, indeed, that is not an end in itself. The objective is here to make the benefits really available to European consumers and businesses, and also to base this indeed on European values and a sound regulation of risk. Because, of course, even digital finance is still finance, and as such is subject to certain old risks, but also new risks. In this context, indeed, we have adopted a policy actually both on artificial intelligence in the general context. And our assumption is indeed that AI is good for consumers, businesses, but also the public interest. But that, of course, there are certain use cases which do create some risks for safety and also for fundamental rights. And this is the underlying approach of an artificial intelligence package, which the Commission presented in April, just last month, actually, based on the principle of excellence and trust. And we have, first of all, actually continued actually what we call the coordinated plan on AI, actually a joint commitment between the Commission and member states by working together to make sure that Europe maximizes its AI potential indeed. And this has indeed quite a number of pillars. On the one hand, setting enabling conditions for AI development and uptake, making the EU the right place from lab to the market, ensuring AI technologies work for people, and building indeed leadership in the various sectors here. And this is all underpinned both indeed by, let's say, regulatory approaches and indeed by funding investments from the Horizon Europe and Digital Europe and other programs which we are having. And those programs, as you know, actually the resources have been further boosted in the recovery after the pandemic, the recovery and resilience facility, where indeed all member states actually have to put a certain amount of the recovery funds into digital developments, and AI, I think, is one of them. So I think this is a bit, in a nutshell, the big picture from our side, and I will now focus indeed on one part of this picture, which is actually the proposal for a legal framework for artificial intelligence, because I think that's a bit the focus of today's debate, the regulatory aspect here. But I wanted to make very clear that this is only one of a multitude of, let's say, elements which our broader strategy on AI actually includes. So indeed, the Commission has actually set out last month, also in April, a proposal for a legal framework for artificial intelligence. And the moment you start to look to legal rules, of course, you need to, first of all, define what you're looking at, which is sometimes not very easy in case of new technological developments. So actually, we have endorsed a definition of artificial intelligence, which should be, in our view, as neutral as possible in order to cover techniques which are even not yet known or developed. The overall aim which we are pursuing here is to cover all artificial intelligence, including also traditional symbolic AI, machine learning, as well as hybrid systems. And so actually the approach we have selected is to have a relatively broad, open definition, and then indeed a list of AI techniques and approaches which should provide indeed for legal certainty and which can be actually updated over time. What is then the approach which we are suggesting in terms of the regulatory framework? Actually, we are proposing a risk-based approach which looks at the different uses of artificial intelligence. So it does not look at various sectors, because indeed, let's say, risks can be high or low in different applications mainly, but not so much depending on the sector, but really on the way actually AI is used. And so indeed, we have in a way developed a kind of a cascade from actually the large bulk of applications, which are probably going to be minimal or no risk, which you see at the bottom here of the the slide, then actually AI which requires some specific transparency requirements, impersonations, bots, for example, where indeed human interaction is actually is happening. Those are permitted, not subject to particular actually specific requirements, but some information and transparency obligations. Then we have selected a closed list of actually high risk applications. And I'll come actually to the area of finance in a moment, where just a few applications would fall in this category. Those are also again permitted, but subject indeed to compliance with particular actually requirements and an ex-ante conformity assessment. And I will come to that a bit more in a moment. And then indeed, we have also identified a number of practices which in the European Commission's view present an unacceptable risk. For example, social scoring and other technologies, and those actually would be prohibited according to our proposal. So I will focus now in the next slide indeed on the high-risk artificial intelligence systems, which are those which are permitted but subject actually to certain requirements. And those include a number of actually systems in a number of fields, safety components, for example, of regulated products because of the particular actually relevance for health and safety. And then I think a number of AI systems which are particularly relevant actually for fundamental rights, let's say, for exercise of fundamental rights. I think that is in our way are the two key drivers which actually determine to what extent actually one needs to look at particular risks. One is indeed possible impact on safety, health and safety. The other one is actually a possible impact on fundamental rights. And in that sense, indeed, we have identified a list of areas where this possible impact would actually be relevant. And in the financial sector, I think this includes in particular the area of creditworthiness assessments for natural persons, because indeed such creditworthiness assessments actually are relevant and important both for actually the access to the access to finance of natural persons, but also very often, as you know, used indeed for broader access to services, to telecom services, to actually sometimes to housing in some member states and to other services. What would then be the consequence of this? Indeed, for these high-risk AI, actually, we are proposing a number of requirements which are based indeed on the work of the high-level group, which has advised the Commission over the past years, and you know actually the report of this group. And those principles are indeed the establishment and implementation of a risk management processes, which would have to ensure indeed training, validation, and testing of data, which would ensure establishing documentation, an appropriate degree of transparency, human oversight, and robustness, accuracy, and cybersecurity. So you see all relatively high, more principle-based actually requirements, which are, I think, well known and familiar actually to everybody who is working with AI. And what would that then indeed, how would these have to actually be implemented? So we are suggesting actually to look both at the provider and at the user actually, particularly, let's say, to require that the provider indeed establishes and implements a quality management system in its organization, draws up the technical documentation, undergoes conformity assessments, post-market monitoring, etc. And then for the user actually to make sure that he or she operates the AI system in accordance with the instructions of use, ensuring human oversight, keeping logs, informing about serious incidents, and ensuring that existing legal obligations, for example, on data protection, actually apply. How would this then work actually in the financial sector? As I mentioned already, we have identified only one high-risk use case in the financial sector, which are AI systems actually intended to be used to evaluate the creditworthiness of persons, of natural persons actually, or to establish their credit score. We also have exempted from this indeed AI systems developed by small-scale users for their own use, because here we do see a little less risks indeed of exclusionary effects. And of course, we have to take care that indeed some entities active in this area are not regulated and supervised. for example, credit bureaus. We do not have actually common European rules on this. They will be subject indeed to the full set of rules I mentioned a moment ago, indeed, with the requirement of having an ex-ante conformity assessment once those systems are put in place, and indeed a conformity mark, etc. Now, on the other hand, of course, financial institutions are already regulated and supervised quite tightly by European law. And in that context, indeed, we are proposing actually to integrate the compliance with these new requirements into the financial supervisory system. So it would indeed, rather than having actually a dedicated conformity assessment, indeed would be up to the financial supervisors to integrate actually in their assessment these requirements, to integrate them into the supervision. And I think, for example, when it comes to creditworthiness assessments, which is the case here in point, we see very much, and I think ACPR has already done quite a lot of work on this, that this is something which needs to be integrated actually into the annual supervisory review process, which is the moment indeed where prudential authorities are actually also assessing the credit models of financial institutions. So this is, I think, in a way, in a nutshell, how we would see the system to work, particularly for this high-risk use case of creditworthiness assessments. Now, above and beyond that, and above and beyond the still more general principles which we are proposing to set out in law, we do think that financial institutions need actually also a lot of supervisory guidance to understand actually how are supervisors approaching AI systems, particularly in various areas, and here in that sense going beyond actually this case, but also looking indeed at the use in insurance, at the use more in actually direct actually end user contacts, etc. And in that sense, I think we propose to continue an approach where the European supervisory authorities actually, so EBA, EIOPA, and ESMA, would give guidance actually on how financial supervisors could actually apply the existing financial services rules, particular to II applications. I think the EBA has already done this actually in the particular area of loan origination, where indeed the EBA integrated a certain amount of guidance into their guidelines on this. And this is an approach which I think is a good approach actually, which should indeed also give, first of all, cover a broader set of users in the financial sector, and then also give indeed financial institutions very concrete, very specific indications on the use of AI. So I have now a last slide actually on the next step on the legislative proposal which we have made on the rules which I presented actually for AI. These are now indeed negotiated by the European Parliament and the Council as co-legislators, and then indeed will come into force at some point across the EU. And in parallel, of course, I mentioned on the one hand the work of the ESAs actually on guidance, and on the other hand, indeed, in probably more other areas, indeed, CEN and CENELEC actually are actually continuing to develop harmonized standards in this area. I hope I was not too long. I tried now to focus a bit, as I mentioned, on the regulatory framework which the Commission has proposed, because that is a relatively recent development. But I wanted to close by indeed highlighting that we really very much actually see AI in finance as a fundamentally, let's say, development with a lot of opportunities which we want to support. And we do think that on the one hand, legal clarity, but on the other hand, indeed, also appropriate funding and let's say appropriate cooperation between supervisors and firms is essentially necessary to develop this, and that is something on which we from the European Commission side will continue to lend our support.
Thank you very much, Ian, for this presentation. Now that we have in mind the risk-based approach proposed by the European Commission, we can give the floor to Xuchen Li from the MAS, from the Monetary Authority of Singapore. Xuchen, if you want to present your slides.
Yes. Yeah, can you hear me? I just tried to upload my slide, but I don't know why I can't. I think I set a version to you. Can you help me to upload my slide? Can you see my slide now?
Yeah, it works. Yeah, it works. It's perfect. Yeah.
Okay, great. Okay, thank you. So I will start. Hello,
yes,
everyone. Hello,
yes,
everyone.
please.
This is Fliche. I'm from Monetary Authority of Singapore. I'm heading the AI development office from there. So today I want to share with you our journey on the responsible AI, our FEED principle to guide the financial industry how to use AI properly, and our new initiative, which is called Veritas. So responsible use of AI. I think you may heard this quote from Apple CEO that what all of us have to do is to make sure we are using AI in a right way that is for the benefit of humanity, but not to the detriment of humanity. Around 4 years ago, MAS released the FEED principle, FEAT. The FEED principle is a guidance to provide to the financial industry to use AI properly. It includes the fairness, ethics, accountability, and transparency. Here are some examples of the FEED principles. How we assure the AI solution is fair, how we can guarantee the ethics, and who should take the responsibility in the AI system. And the last is transparency. How could we make sure the AI solution is not a black box? The Veritas initiative. Before I talk about the Veritas initiative, here I give a broad view about the global AI governance landscape. You can see around 3 years ago, MAS published the FEED, and also Japan, Europe, China, Hong Kong, and recently US, United States, all published their own related AI governance related principle, guidance, etc. So Veritas, after we published our FEED principle, we received a lot of feedback from the financial institutions that implement the FEED principle is very challenging. For example, how to assure the systematic disadvantage, how to measure it, how to pick proper fairness metrics, etc. And because of that, around 1.5 years ago, MAS working together with the financial industry and big AI firms and AI startups to create a consortium. We call it Veritas Consortium. So the goal of this consortium is to develop a methodology. This concrete methodology can be implemented by the financial institutions, which can be used to evaluate the fairness, ethics, accountability, and transparency of their AI systems. And furthermore, our goal is not only publish the methodology, but also develop open source code so that everybody, no matter it's Singapore financial institutions and even global financial institutions or academy, can use the methodology, can also use open source code to validate their AI systems. And we are also open and welcome everybody to join the open source ecosystem to further develop the methodology. And we hope this can create a more responsible use of AI in the Singapore financial industry. Last year, we have finished the Veritas Phase 1. The Veritas Phase 1 has been announced by our Deputy Prime Minister as part of Singapore National AI Strategy. And in the Phase 1, we only focus one principle, which is the fairness. And we have published, we have a select 2 use cases, which is credit risk scoring and the customer marketing in order to develop the methodology. We have finished the Phase 1 and delivered one white paper, which is document the generic methodology to assess the fairness of AI system. And also another white paper, which is a use case study for the credit risk scoring and customer marketing. And based on the 2 use cases, we also published the Python open source code, so everybody can download and have a try. So now I give you a high-level explanation how our proposed methodology works. It is a comprehensive 5-part methodology to assess the alignment of the AI system with the FEED principles. The step 1 is to describe your AI system objective and the context. For example, your AI system is to make more money, to lending more loans, The context may be only land loan for a subgroup of a population. The part 2 is to examine the data and the model for unintended bias. And part 3 is measure the disadvantage. How to measure the disadvantage, how to use mathematics, data analytics to achieve that. Next step is to justify the use of personal attribute. Of course, the banks may select some personal attribute. They need to show justification why they use this one and why it is fair. And the last and not least, it is to examine the system monitoring. So this is like a flow of how Veritas methodology works. Step 1, you can see define the scope of assessment, then adapt the assessment based on the use case. Of course, you need to answer some questions. We provide a question list in the methodology. After that, gather required information as a data, the knowledge, etc. After that, decide the measure and metrics. Here, meaning the measure to measure the fairness metrics. For example, you can use different metrics to measure the fairness. After that, complete the system review and then provide a report and feedback to the necessary stakeholders. This is how Veritas open source looks like. You can find it from the GitHub, which is the most popular open source repository online. Over there, you can download the code and have a test. Veritas Phase 2. So this year, we start the Veritas Phase 2. Based on the work in the last year, we further extend the Veritas scope. Last year, we only focused the fairness. This year, we cover all the 4 principles, which including fairness, ethics, accountability, and transparency. And last year, we only focused on the 2 banking use cases, which is customer marketing and credit risk scoring. So for this year, we further extend to insurance use cases, including insurance underwriting and also fraud detection. Here are the key members, or we call it lead members, who will work together to develop the Veritas methodology. And we are targeting by the end of this year to publish another round of white paper to document the methodology, which is used to assess all the 4 principles and also the use cases. Furthermore, we will also publish open source code which implements this methodology. So here is the number of our other consortium members in the Veritas, including the FI members who provide domain knowledge and help review the methodology, the lead members, which including the financial institutions and tech firms, which is in charge of developing the Veritas methodology, facilitators such as MES and the consulting firms, and advisor members, which is a global lead AI firms in these areas or some society. Okay, I think that is my end of the presentation. Thank you.
Thank you very much, Christine, for this presentation. Now, so the idea of this webinar is to articulate academic presentation with institutional presentation, and now we have the pleasure to welcome John for a third presentation. I don't know if we have. John, perfect. Thank you very much. See the slides.
I'm just trying to make sure I get the right set of slides. No, that's not the right one. Do you see my slide?
Yes, but the screen is very tiny.
Okay. Yeah, that's better.
It's
Thank
better.
you for inviting me. It's a great pleasure to participate in this webinar this morning. My comments focus on the relationship between product regulation, of which I am going to characterize the AI law recently proposed by the Commission as an example, and corporate governance in the financial sector. So just to start with some very general observations around the challenges of regulating new technologies, which I suspect will be familiar to everybody participating. When we are introducing new technologies or new applications of technologies, there are new risks, some of which can be foreseen and can be managed ex ante through appropriately crafted regulation. However, other risks associated with new technology are not foreseen in advance, and these are what we call emergent risks. That is, risks the nature of which only emerges after the technology or application has been deployed. And then the question for regulation is how to manage these emergent risks in advance. And on the one hand, probably the best known principle here is the precautionary principle, which is that where there is a potentially serious risk of harm associated with emergent risks, then the regulator should restrict deployment of the technology or application until it has been adequately tested, and then we can understand the parameters within which it can be used safely. And this principle is widely used in the regulation of new technology, and also probably most intuitively applied in the context of pharmaceutical regulation with respect to drug testing. At the same time, though, we have to be proportionate in the extent to which we apply this principle, because we are concerned, obviously, with safety, but the deployment of new technologies can yield considerable social benefits. And so do we forego those benefits by excessive application of the precautionary principle? And so there's a case for applying proportionality here and permitting deployment subject to close monitoring and reassessment of the balance should issues emerge. And a very clear and salient example of these principles being applied in real time is over COVID-19 vaccinations, as we've all experienced in the last few months. So turning then to the AI regulation, as Jan explained, divides use cases for AI into three risk-based categories. So some AI use cases are prohibited. These are seen as posing unacceptable risks. These include exploitation of subliminal messaging or vulnerabilities associated with age and disability in a user. And then for systems deemed to be high risk, then the regulation prescribes minimum standards associated with their deployment. Now, in the financial sector, the key application that is designated as high risk so far, at least at the outset, is the credit assessment of natural persons. But the proposed regulatory framework sets out a scheme by which other deployments could also be classified subsequently as high risk if problems emerge. So there is a way of managing emergent risk with AI by shifting things that don't initially be classified as high risk into the high risk category if problems emerge. So the things that are required, the minimum standards, Jan went through these. These include the relevance and statistical significance and freedom from bias of the data, transparency of the system, the need for some oversight by natural persons, so human in the loop, the robustness of the system to technical failures, and its is safeguarding against cybersecurity risk. So the way these are to be applied is that a conformity assessment must be carried out before the deployment of the system, and then this will follow through into a CE marking associated with the system that the user will then be able to rely on. So I mentioned then that in addition to this, the only application of these high risk minimum standards in the financial sector to start with will be the credit assessment of natural persons, but the regime also encourages providers to develop voluntary standards for systems that are classified as low risk. And so I would see this as an example of encouraging self-regulation in the shadow of the law. So on the one hand, we have these standards set out in the regulation for high-risk systems, and we have also the proviso that the scope of high-risk systems may be expanded. And then we're told that providers can self-regulate for systems that are low risk. So I see, therefore, strong encouragement for providers to apply these sorts of standards voluntarily to low-risk systems, even where they're not required to do so, so as to ensure that they don't subsequently generate risks that might be classified as high risk, which would then lead to mandatory minimum standards being applied. There are also, in order to facilitate innovation and controlled experimentation, the regulation provides for the establishment of regulatory sandboxes. So applying this to the financial sector, the oversight and enforcement, as Jan said, will be devolved to financial services supervisors for regulated financial institutions, so national competent authorities for financial services for supervision, the European agencies for the rule writing, and the ECB for large Eurozone banks. And the conformity of firms' applications to the mandatory minimum standards will be certified by firms utilizing their existing risk management and governance processes. So this is the link then to corporate governance, because the regulation divides into sectors in which there are existing third-party safety certification regimes, and in those regimes, conformity is to be certified by those third-party agencies, and sectors in which that kind of third-party safety certification doesn't exist already, and therefore the greatest expertise is thought to lie with the firms in the sector, and they are to be encouraged to utilize their existing risk management and governance processes to ensure conformity. So having said that, I want now to link to the way in which governance processes are used in financial services vis-a-vis consumer or retail investor facing financial products, because the AI regulation is essentially imposing some minimum standards for AI products that are to be deployed. How are financial products regulated and governed under existing financial services frameworks? So we in the financial regulation space distinguish between product regulation and product governance. So product regulation involves the setting of minimum standards for products which are established by regulators. And in the context of financial products, this typically means the structure of the products themselves, the way in which they are designed and marketed. And an example of a well-known example of a highly intensive product regulation regime is the UCITS framework used for undertakings for collective investment in transferable securities. But we also see product regulation in a number of other sectors or types of product for retail investors. And designing a product regulation framework, financial sector regulators must understand the risks and calibrate the rules effectively, because in the cost-benefit analysis, one needs to be clear about what the costs of non-intervention will be, And the way in which financial services firms can innovate products, can change the terms on which they offer products, can innovate products that arbitrage around the scope of application of existing product regulation is very fast. And so that makes it a challenge for product regulation to keep up with the pace of industry innovation. So a regime that was introduced in the UK by the Financial Conduct Authority and has been now applied more broadly in the EU under MiFID II. It's product governance, under which firms are required to establish processes for the design and marketing of products, where the process right from the get-go, right from the start of the design of the product, has to focus on the benefit to the consumer. And the advantage of this kind of approach is that the firm typically has lots of information about its market, it has lots of information about the ways in which consumers behave, and it can use that information to design a case for a product that benefits the user based on the firm's analysis. And so the governance requirement for the firm is that they have to have in place a process that yields a demonstration of a case for a consumer benefit in the design of a product, and also seeks to restrict the marketing of the product to consumers who meet the specification of the type of consumer who will benefit from the product. So it's designed to stimulate the development of products that yield benefits for consumers and avoid exploitation of consumers and inappropriate marketing of products by linking that to the firm's governance processes. So this harnesses the information, the data available to firms with the goal of establishing benefits for users. And I think it's going to be very important in the application of the AI regulation to the financial sector to link the AI regulations requirements, both the relatively limited application of the mandatory requirements and the more the broader sort of penumbral application in the shadow of that regime to low risk contexts, to the existing product governance frameworks, because these frameworks focus, as I've said, on delivering new products that benefit consumers. And what I think would be desirable would be for AI deployment in this context to be brought within that, so that the firm has to demonstrate that its application of AI in the design of the product, or when it's designing a product that is going to use AI in the product, that will be yielding a benefit for consumers. And that, I think, will be consistent with the goal of deploying AI in a way that's beneficial. At the same time, it's desirable that the firms be free to use the data that they have to deliver these kind of product governance obligations. So that's a point of integration between the new AI regulation and existing financial services regulation. Having said that, though, a key this slide emphasizes that point I've just made. So that it's important to link the AI compliance and data governance that's being introduced by the new regulation with existing product governance framework, and that this, I think, can help to ensure an overarching approach to the deployment of AI in financial services that focuses on consumer benefit. So going beyond just a list of generic minimum requirements that the regulation establishes and a sort of tick box approach to compliance, but actually an approach that seeks to ensure a focus on deploying AI to deliver a clear benefit for consumers. So that's what I think the promise of a product governance approach, of marrying existing product governance regimes with the new AI regulation can deliver. The challenge with that is the challenges of corporate governance and compliance generally, and specifically with product governance obligations. So how to ensure that financial sector firms buy in a serious way to compliance with these obligations. So a point that I think is highly salient is that corporate penalties, even very high ones, are not sufficient by themselves to ensure compliance, and the AI regulation prescribes extremely high potential penalties for organizations that violate the most serious obligations that it will impose. The problem is that people who are running firms who are compensated in stock, which is very common, of course, in large public companies in the financial sector, may face incentives to short-termism, and this is something I've written about quite a lot in recent years. So if we think about the stock price, the degree of compliance that the firm has with regulation is very hard for investors to assess. It's a sort of thing that depends on factors that are internal to the firm and are not publicized. And so a firm that's not completely compliant with financial services regulation or indeed with AI regulation, that's unlikely to be something that investors will know about, and it's unlikely, therefore, to be priced into the stock price in the short run. Non-compliance, of course, creates risk for the firm, major risk for the firm of financial penalties. But these are long-tail risks because it takes time for non-compliance to be discovered. And so if one has stock-based pay, which senior executives are compensated over a shortish time horizon, and the stock price doesn't take into account the quality of compliance because investors can't assess it, then there may be incentives for senior executives not to invest enough in compliance, not to take compliance seriously enough. And that governance problem undermines product governance, it undermines compliance with rules like the mandatory minimum standards that the AI regulation will prescribe. So a solution to this is, I would suggest, not just longer minimum vesting periods of the sort that we've seen in recent years, but also making sure that there are effective regulatory duties of care or responsibility for senior executives vis-a-vis failures in compliance. And here in the UK, the Financial Conduct Authorities introduced the senior managers regime in recent years that prescribes a duty of responsibility for senior executives with potentially unlimited regulatory fines for failures in compliance that occurred under their responsibility. And that sort of severe potential sanction for individuals, I think it's important also to think about in terms of making compliance effective on the ground, because of the distortions between the time horizons of individuals and the time horizon of the organization. So I'll just conclude by summarizing the points that I've made. The AI regulation is trying to manage an example of emergent risk. It's doing that with a set of mandatory minimum standards that apply for a specified type of applications. The deployment of this in the financial services sector will come onto the body of existing financial services regulation. I think it's highly desirable that this be integrated with product governance obligations, but equally, I think that product governance and indeed regulatory compliance more generally needs to be based on sound incentives for senior personnel in financial services organizations. And here we need to think about the interaction between remuneration and liabilities for failures in compliance. Thank you. I'll stop there.
Thank you very much, John, for this presentation, and it will be very interesting to see the comments by Yen during the roundtable. So some people ask questions in the chat, so feel free to ask more questions in the chat, and we will take them in the roundtable just after the different speeches. Now we welcome the last speak by Douglas. So we are very happy to have you on board, Douglas, for this webinar.
Thanks very much.
So if you want to share your slides with us.
Very good. Thanks, David. Thanks, Olivier. Thanks, Astrid. And thanks to Télécom Paris and the Banque de France for the invitation to be here today. I'm going to, I think, look at a couple of things that relate to what we've looked at so far, but also reinforce a couple of the approaches that others have suggested. And as David suggested, I'm just going to bring up a set of PowerPoint slides quickly. That looks good. Now, part of this is going to draw on a paper, which actually I think says in many ways exactly John's conclusion, this idea of putting the human in the loop in the context of artificial intelligence, co-authored with my colleagues Dirk Zetsche at the University of Luxembourg, Ross Buckley at University of New South Wales, and Brian Tang at Hong Kong University. And, you know, I think when we're looking at AI, we all sort of understand the context, this trend of digitization, of datafication, and something that we've seen accelerated pretty dramatically by COVID in the context of digitization of everything. And I'm going to focus in specifically on how some aspects of financial services are perhaps a little bit different, or perhaps the key point here is that when we are thinking about the application of AI, one of the sectors where that has been the most developed is in the context of financial services. And financial services as a regulated industry is almost uniquely subject to regulation. And so the question of, in the context of this sort of regulated industry, what sorts of regulatory approaches are available? And I'm going to kind of conclude with three different ideas. One, from the standpoint of approaches to financial services from regulators to the industry. Second, from the standpoint of regulators using AI increasingly themselves. And this is something that I think there's a real trend towards not only increasing use of AI in the financial sector, but also by regulators in the financial sector. The final point, one that we've already highlighted, particularly in the opening presentation, about thinking about systems design and how we can use design strategies in different places to perhaps support competitiveness in this context. And, you know, if we're thinking about financial services, I think it's important to start with this point that financial services is in fact one of the most digitized sectors of the economy, that this is a process of long-term digital transformation, and some specific characteristics, I think, make the financial sector very fertile ground for some of the AI developments we've already seen, but also a number going forward. And of course, if we think about the trends that underlie this most recent wave of discussions around AI, it's really around these mega tech trends of increasing amounts of data, the digitization of everything, storage capacity, massive increases in storage capacity, in particular cost and size, communication, the ability to communicate very large amounts of data in different ways, computing power, of course, and from the standpoint of both theory and technology, massive developments from the standpoint of analytics themselves. Now, when we think about AI in finance, I think there are four pieces that have led finance to emerge as one of the leading users so far of AI. And of course, when we think about AI, probably the fundamental piece is data. We know that the more data you have, the better you are able to train systems, the better they are able to work. And so when we think about AI in finance, the reality is that because of, in particular, disclosure frameworks developed over the past century, we have vast amounts of data that is often already in structured forms. Think about stock market data, and generally highly digitized. What that means is that one already has a very large pool of data available as a starting point. Second, we know that AI tends so far to work best in environments where there's very large amounts of data, but a constrained set of rules around how that data can be used and specific objective outcomes. Think about things like chess or Go. And of course, financial services, if we are thinking about stock trading, this is something with a pretty limited objective, that is to maximize profitability, and very structured, large amounts of data subject to specific forms of trading rules. All of this means that particularly trading and risk management have not surprisingly emerged as some of our most cutting-edge use cases for AI. The second is around financial resources. And for much of the past 30 years, the financial services industry has been amongst the highest spenders on technology. The end result is that the financial resources have been there and available from the standpoint of really a constant arms race from the standpoint of application of technologies, particularly to trading. To the extent that we can think back to 1987 market crash, program trading, already digitization and competition from the standpoint of automation and analytics was already well established by 1987 in financial services. And if we think of areas around use cases of AI, if we think around even the context of independent AI, we are seeing experiments with the use of robo-advisors and other sorts of systems that are really cutting edge. Human resources, financial services, of course, pays well. And it also has a system of incentives, as John mentioned. And these incentives very specifically drive performance and a constant search for tools. And it has to be said as well that when we think about the discipline of finance, we have an entire academic discipline that is very focused on the use of quantitative modeling techniques to support activities in the industry. And it is this particular combination that has made financial services particularly fertile for AI. And if we think about Europe, I think it's worth mentioning that we've seen a massive acceleration in digitization of financial services in really a very short period of time, the last 5 years or so. And before COVID, a combination of a vast increase post-2008 in digital regulatory reporting requirements, particularly under MiFID II, new data protection regulatory requirements, which applied to financial services, but financial services hadn't paid much attention to these in most cases pre-GDPR. Of course, open banking in PSD2 and linkages through the eIDAS regulation. COVID, of course, has driven this even further, particularly from the standpoint of regulators, but also from the standpoint of financial institutions looking at their operations in a different way. So, if we are thinking about use cases, obviously issues around security. We've all seen the stories of AI chatbots, which they're cute and they have customer protection implications. But if we think about the majority of spending in financial services, it's really around AI and operations and risk management and around finance and investment. I mentioned trading. Big focus, investment, the evolution of robo-advisors and automated trading systems, of course, and as we've highlighted on a couple of occasions already today, around lending. And lending, when we think about some of the giant digital finance platforms like Ant in China, we can think, of course, of the positive benefits of automated AI-based lending in particular for SME lending and the benefit that this can have, but we can also think about some of the challenges around concentration. And of course, from the standpoint of compliance and regulation, lots of discussions around use of AML, but also much more widely from the standpoint of things like stress testing, internal modeling, value at risk, and the like. Now, when we think about financial services, I think it's important to think about that this is a regulated industry. And as a regulated industry, there are a range of specific financial regulatory considerations that we need to take into account. And the first of those is around financial stability. And of course, to the extent that we think about use of AI in the context of trading, of high frequency automated trading, of flash crashes, of internal risk management systems, of stress testing, we can think about the fact that actually AI does in fact raise concerns from a financial stability standpoint and merits a range of monitoring. And of course, related to this are issues of cybersecurity. The greater the reliance on digitized data and modeling, the more risk one can see of catastrophic outcomes from the standpoint of cybersecurity. Of course, one can think about fairness, customer and investor protection, market integrity. And this is where we begin to think about nature of data risks, dependency, availability, interdependence. But it's also important to think about potential risks from the standpoint of innovation and development. As we've seen in China, for instance, financial services, like tech, is an industry which appears to be characterized by network effects, economies of scope and scale, resulting in tendencies towards dominance and concentration, and particularly winner-takes-all outcomes. And as a result, from a wider public policy standpoint, questions about how do you go about balancing the fact that we want to encourage innovation in AI for societal benefit, but that often the best way or the easiest way to get there is mass concentrations of data and the risks that that brings. From the standpoint of regulation, we can think of a variety of questions. Should you have a specific authorization? Should there be an outsourcing rule? Should you apply a sort of e-personhood in some cases, a fit and proper analysis, or key function, data protection, data privacy, protected factors that we've highlighted, and of course, accountability. And I think we highlight differences, as John has done, between your sort of corporate governance-based approaches, but also your external regulatory approaches. We can see these, of course, in some cases around capital, stress testing, even licensing in some cases, but we focus in particular on the need for human responsibility. And in finance, we have this evolution over the past decade in major jurisdictions around the world of essentially personal responsibility systems, whereby individual managers as well as senior executives can be held directly responsible. And we think in the context of finance and really of any regulated industry that this is a very important tool to encourage due diligence and explainability out of personal self-interest through direct responsibility of an individual human being for whatever may come from systems. The second aspect is really this idea around the use of AI by regulators, the idea of RegTech and SupTech. And I think what we're increasingly seeing is this process of digitization. As we have an increase in digital regulatory reporting, that then sets the basis for analytics and the use of AI and a range of other tools in regulatory operations. And our feeling is largely the same, that from the standpoint of holding the regulator accountable for its own use of AI, it is also important to have these sorts of personal responsibility systems, not just from the standpoint of court proof, but also from the standpoint of potential liability from the standpoint of the industry. Now, the last point where I want to close is really around this broader idea. And I think that's something we are thinking about. And certainly if we look at the EU's digital finance package, the wider strategy, we can see embedded in this the overall objective of trying to encourage a competitive approach to use of data and use of AI. And what is beginning to emerge are a variety of different approaches between major jurisdictions in the context of approaches to data. Because after all, if we think of this from the standpoint of training of AI, the base point is the more data you have access to, the better your systems are likely to be developed. But there are a variety of ways in which that can happen. So far in the US and China, there has been a tendency towards a property-based approach, which not surprisingly has resulted in large private sector agglomerations of data. The EU is adopting a different approach, which is not that sort of property-based approach, but a much more rights structure. Now, if we think about the US and China, there are growing concerns around this approach, and particularly in China, questions about if data, from the standpoint of AI in particular, is a public good. Well, then, perhaps you should think about ways in which data should not be subject to the control and limitation of a single company. But it's interesting, if we look at the contrast between the approach that we're seeing in the sort of GDPR structure versus where China appears to be going at this stage, it appears that China is increasingly going to systems whereby the objective is to separate mass pools of data from the large tech companies and open them up to wider use in order to both reduce the dominance of the tech companies, but still at the same time make those data pools available in order to support development and innovation of AI. And I think as we go forward, we're going to be thinking about these big picture issues in terms of how do we structure legal and regulatory systems, particularly in financial services, to balance our overall positive objectives with some of the negative tendencies which we can see developing, in particular as a result of network effects and potential winner-takes-all outcomes. Thanks.
Thank you very much. Thank you, Douglas, John, Xuchen, and Yen for your presentation. Maybe before open and ask questions from the chat, so we have also questions. It will be interesting to have a brief discussion between Yen and Xuchen, because we clearly see some different approaches between MAS and the European Commission, for instance. And then I would be curious to have your reaction, Yen and Xuchen, on the different approaches. And also we have a lot of questions asked by Douglas and John in their presentation about some issues or concerns related to the approach by the European Commission based on the risks. Sometimes it's difficult to foresee some risks, as John said in the presentation. So maybe we can open this roundtable with you, Yen and Xuchen, to have your reaction about the different approaches in Singapore and in the European Union. John?
Yeah, no, thanks so much. I think this was very, very interesting and really has shed light on a lot of different aspects of the topic. I would actually not necessarily see really a contradiction, I would say, between the different approaches. I mean, indeed, I think what I presented, and I think the the regulatory approach which the Commission presented actually indeed sets out a regulatory framework for a very few selected cases. But first of all, it is only a few cases, and I think many of the cases indeed also which I looked at in Singapore are actually quite different cases. And in that sense, I think let's say the approach which I also mentioned on our side, that we intend to work with the European supervisory authorities actually to provide broader guidance actually on applying AI in the financial sector at large, is probably quite comparable to your approach. Now, I think what I find interesting is indeed that you have worked also teamed up very closely with the private sector. I think that's something certainly to consider. But again, I think as was also mentioned, indeed the suggestion from the European Commission side actually beyond the high risk cases to work on actually on self-regulation, to work actually on an industry standard is in a way a quite comparable approach, I would say. So if I can, I think the key difference is probably that in addition, on top of this, from the European Commission, we've said, well, there are some cases where we need to have a regulatory framework, some kind of hard law regulatory principles. Maybe why is that maybe let's say the case in Europe? I mean, certainly I think in Europe there is a very strong focus indeed on data protection and on fundamental rights, and I think we will also probably not see a strong acceptance of these technologies unless people are sure that there are indeed safeguards in place. I think that's maybe one factor. Another factor I would see is that indeed, of course, in Europe we still have 27 different let's say authorities who are actually enforcing the rules. And so very often actually also having binding common rules is one of the only ways actually to make sure that everybody is on the same page and moving in the same direction, basically, which is of course different if you are in a context like Singapore, where you just have one authority which is in charge. So I think that's maybe also something which explains this approach. But I would think that even in the areas which we have identified as high risk, the creditworthiness assessments of natural persons, of course, the regulatory system is one thing. It's another thing to actually to apply this in practice. So how will actually supervisors look at this? How will they apply it? How will firms actually implement it? And in that sense, there I think we could see quite some convergence of approaches, I would say. So sorry, I was now a bit less contentious. Probably for the panel, you like to have let's say differences and different approaches. But I think probably, I mean, there are differences, but I think they are also partly explainable by the different setup between EU of 27 member states and Singapore, and indeed by, I think, the probably the stronger, let's say, data protection and fundamental rights approach which we have in Europe, and which really needs to be addressed so that these technologies are actually acceptable also to the public at large.
Thank you very much.
I agree with Jan. I think I don't see a big difference between European approach and the Singapore approach. As I mentioned 3 years ago, when we first published our FEED principle, it is a guidance. It's a principle-based guidance. It's also risk-based guidance. For important high-impact case, maybe we ask more. Okay. The only difference at this moment is MAS maybe we are doing one step further regarding the Veritas project, because the feedback from the financial institutions that implement the principles is a quite big challenge. I already explained what's the definition of the fairness, which fairness metrics they should select, how to use the data analytics to measure the systematic disadvantage, etc., etc. These are the very concrete challenges for the financial institutions when they really apply the guidance in the practical. So that's why MAS want to currently working with the industry, which is to do one step further to develop a concrete methodology and also open source code, so that every financial institutions can rely on this methodology. Of course, they will adjust and they will make some decision by themselves, such as what metrics they will select, such as what is their fairness objective. But at least it is a systematic methodology, and also have some reference source code. Then the banks can probably, we hope, can leverage on this methodology, Veritas methodology, and also the open source code to really implement the principle. But again, in general, the principle, I think they are quite similar as what European is using. yeah, that's my comment. Thank you.
Thank you very much. Olivier?
Yes, if I may jump in. Just in line with this first question, I think maybe one difference is maybe the articulation between transfers and sectoral regulation. I think in Europe we see that we are going to have a general framework, and then the European agency will be in charge of guidelines. So my question also to Xushun and to Jan, and maybe also to John and Douglas is, well, there are some specificities on the financial sector. I mean, Douglas made the point clearly. So how do you think AI regulation should be articulated between financial sector and general regulation? For example, a question to Xushun, when you speak about fairness, ethics, how do you ensure that the principle for the financial sector are consistent with, I would say, regulation, general regulation? And the second question maybe, which is suggested by one question in the chat, I think one question is about biometric identification or this. Is there a case for the financial sector to be, since it's a very regulated sector, do you think we should have even more regulation due to AI, or do you think we should build on financial regulation and maybe adapt AI general regulation to the financial sector? Maybe Xushun first.
Sure. I can share a little bit Singapore experience. What in Singapore we did is we have a guidance, which I mentioned, called FEED for the financial industry. We also have a little bit of broader guidance, which is released by our another government agency, which is the guidance for all the different sectors. So what we did is we work very closely with them to assure what FEED cover, okay, is no conflict with what their general guidance. Okay, so this is first. And second, I think AI is still in the early stage, still evolving. We don't want, because of this guidance or this governance, to stop the innovation. And because of this reason, we actually at the Veritas, we encourage the industry, the financial industry, working with MAS, or we collaborate together to develop something which is maybe useful for them. Okay, again, here is not a regulation. Here is a tool, it's a toolkit, it's methodology, which industry work together with the regulators, especially they among themselves, they agree with this methodology. So that this could be a starting point, a baseline for the financial institutions start to think about how to do the AI governance, how to do the AI governance across the different FIs. And starting from there, since AI is evolving, I assume this methodology should be also evolving. We should collaborate together with the academy, with the financial institutions, with the regulators, and even multiple regulators to improve this one. Okay, I hope this helped. Thank you.
Maybe Jan, if you want to.
Yeah, no, sure. I think this is a really very, very challenging question. I think, yes, the answer, as Shannon also mentioned, is probably always that there is a mix between horizontal and sectoral measures. I think, I mean, in the end, or an important part of the justification to intervene here are around fundamental rights, around data protection, and other matters, and those are not issues which are finance only. Those are broader issues. This is different from financial stability, which is the core of the mandate of a financial supervisor. So there will always be a cross-sectoral dimension, and so the broad principles, I think, will always cross-sectoral ones. I think the question is then really when it comes actually to the implementation of those principles, One, to what extent do you need at some point a bit more sector-specific guidance? And there, I would say that is, at least in our view, is the case. At some point, it's simply not anymore the same if you use AI in a self-driving car or in a credit, basically. And the second question is, what is the role of different, to the extent you have authorities involved, what is the role of different authorities? Is it a role of the responsibility of the financial supervisor actually to look at how financial institutions use AI, or is it the role of other authorities? And there, I think from our perspective, at least when it comes to the use of AI in what is actually the core of a financial firm, so the risk methodologies, which are also in a way the core of the things which supervisors look at, this is certainly something which, in our view, is well placed with a financial supervisor. Of course, the financial supervisor, and I think you're doing that very well, will need to develop its knowledge on these matters. I think that is very clear. But in the end, let's say it would make little sense to have, let's say, separate authorities looking at the risk model of a bank. One from the perspective of, let's say, is it a good risk model to develop the capital, and the other one, is it a good AI risk model? But in the end, I mean, the issues you're looking at will be almost the same matter. So that would really not be a very wise approach. And I think also, if you look at our proposals, we now focus on the financial sector. But if you look at the product regulation aspects of our proposal, I think we have the same approach very much, to integrate this into existing product regulation and existing structures, basically. And I think that is also very much to be advisable. Of course, there needs to be a bit of an umbrella, and that's where I think from the European Commission we proposed this European AI board. Basically, let's see how that will develop. So there needs to be, of course, somebody who looks at the bigger principles and how they will be continuing. But the concrete, the way how individual firms actually apply this, to the extent there is a supervisory aspect involved, from our perspective, this should certainly be upon the financial supervisors.
Thank you. I don't know if John or Douglas, you wanted to add something. I think John.
Yeah, I very much agree with the approach that Jan's articulated of devolving this to sector-specific regulators, and obviously where there are fundamental rights involved, the substantive obligations cannot be articulated at a sector-specific level and need to be articulated more generally. But when it comes to the supervision and enforcement, what one needs is close relationships between the regulators and the regulated firms. And that works in both directions. So it makes it easier for firms to understand what they have to do to comply if they are having their supervision in the relevant norms coming from a regulator that they have a relationship with, as opposed to having multiple different regulators that they have to interact with over different dimensions. And those regulators may or may not understand the firm's way of doing things, which can make compliance more difficult for the firm, more costly. That can lead to overlap or underlap and breakdowns. The other way round, it also increases the efficiency of enforcement if the relevant regulator has a close relationship with a firm, because they're able to monitor more effectively. And so I think there's a strong case for channeling the supervision and enforcement, even of general norms, through the sector-specific regulators. And that's very much the approach I understand the proposed regulation is taking.
I think that very much describes what we're seeing evolving in different places. And obviously, when you're talking about a regulated industry, there are reasons why that industry is regulated. And those reasons are something that differentiates the industry, perhaps, from your general sort of situation. And so one wouldn't expect, for instance, a general framework to necessarily be able to address those sector-specific concerns, but to the extent that it was foundational, you would expect it to relate not only to the industry participants, but also to those industry regulators. And I think that is something that is significant as we begin to think about the way that AI is used, not only by private sector participants, but also increasingly by public sector participants.
Okay, thank you. I had also another question, if I may, is I think John and Douglas, you insisted on the question of responsibility, responsibility of the management, and the question with AI is, are we sure that management or even the employees of the sector, or the financial sector, will be able to understand actually the AI algorithm, the AI black box? Well, you may know that this is our favorite question in the ACPR. My question there was, if we say you're responsible for the AI you are going to implement in your bank or in your insurance company, probably the management will ask for certified AI, something which gives them reassurance that the black box is working well. About this question of certification, what are your views as regulator or as lawyers? And do you think we can, is it feasible? Is it relevant? And what would be the advantages and disadvantages of this type of certification? What is your views? I don't know who wants to start first.
I'm happy to jump in on this one and then pass it to John after, unless John is very enthusiastic about going first, in which case, of course, welcome, John. I think when we looked at this, our key idea here was thinking about that if we actually think about ethics in finance, we spent a lot of effort in trying to achieve this, and nothing has really worked very well, if we're honest. Perhaps the best framework that we've come up with is the increasing application of these personal responsibility systems. We, of course, already have a long history at the sort of board or senior management, but more recently, we're seeing it at the sort of managerial level. And I think the key here is a system that basically incentivizes due diligence and application of explainability. In other words, if we think about the sort of parallel area of research in AI that is truly exciting, it's actually AI explainability. And much of this has been driven from defense applications, where defense has basically said, we have to be able to explain how this works if we're going to actually be using it in a military context. And so mandating as part of contractual frameworks, essentially the delivery not only of a solution, but the delivery of an explainability solution. And I think the key point here is that the individual doesn't get to certify that someone said it was good. The individual is responsible for the outcome, and that's not something that gets contracted away in these sorts of personal responsibility frameworks. And I think that's actually key. We've actually suggested that in addition to your sort of individual and board or management level, it may also make sense to have a sort of general explainability requirement, which of course addresses directly the black box issue. And maybe we can't do this so easily in the context of a non-regulated industry, But in the context of a regulated industry like financial services, where essentially we already have these sorts of things, it's only a minor step to expand. We're already seeing exactly this sort of approach in the general sort of IT and cybersecurity standpoint at the managerial board level as well as the individual. And I think it's something that in the regulated industry context is something that is imminently doable and should incentivize an exploration of that black box problem.
Thank you.
I mean, Olivier, the question on certification which you raised is so. First of all, indeed, I agree with everything you said, Douglas, and I think on the importance, indeed, also of personal responsibility in this area. Then, of course, the question is, let's say, how if you're then directly affected by that, let's say, how do you implement this, and how do you actually kind of make sure that this will just not be kind of holding back AI because people are just afraid that that they will not be able to understand it even with trainings, and that's where indeed I think the question of possible, let's say, certifications or other approaches comes in. I think that is in principle something to explore, and I think, let's say, the idea of voluntary code of conduct, which is also in our proposal, which I think John, you also had mentioned, indeed could also give way to such a system. It's, however, of course, also then a question back to the supervisors to what extent they are willing also to basically, both themselves rely on these kind of reassurances, or to what extent they are willing actually to allow the management to rely on it. So I don't have a fixed view on it, but I guess at some point it is unavoidable in this area, because otherwise simply this kind of personal responsibility, it just doesn't. This becomes unmanageable basically at some point. But I think it's a combination. I mean, certainly the first step is for many of our firms actually to just dramatically increase the knowledge in this area.
John, maybe you want to comment or had a comment? Yeah.
Sure. So the one way to think about this is that standards and certification impose a fixed list of things that have to be achieved for a system to be free of liability for people who are using it. And if we think about this in financial sector terms, that's a debt-like obligation. So you have to meet fixed payments, you have to meet fixed obligations, and as long as you meet them, doesn't matter how much you meet them by, as long as you met them, that's okay. Whereas equity-like incentives, you keep pushing because you receive the upside as far as it goes. And so if we have a certification, then we focus everybody's incentives on meeting those standards, and as long as they meet them, then that's okay. But if we have liability that isn't limited to certification, personal liability, then people are going to be more concerned about the scope of that. The obvious drawback with excessive personal liability is that people will say, well, we won't work in the sector, or we won't use the systems at all because we're too afraid of liability. And that's where I think it's crucial to think about liability in terms of processes rather than in terms of substance. And so the product governance approach that I was talking about is framed in terms of process. So it's framed in terms of the checks that are put in place, the processes that are gone through, and then ask yourself, well, how would an adjudication about the adequacy of a process look? What would they do? Well, a good process should look around and say, well, what's the industry standard? And that's what we would expect to be reflected in a certification anyway, right? So it would be at least as good as a certification approach. But I don't think we should assume that a good process would always be satisfied with the minimum industry standard. And a good process should also be asking, well, are there reasons for thinking that the industry standard isn't actually delivering the outcomes that we want it to do? And so a good process should be continually reflecting on that and engaging with that. So there shouldn't be a guarantee for people in the sector that if you are meeting minimum industry standards or existing best practice, that you're necessarily going to be free from liability, but rather you've got to continuously monitor whether there are things that are out there that might mean that that's no longer adequate. But by keeping the obligations procedural rather than substantive, then that mitigates the concern about overarching too much liability.
Maybe in the chat, we have also questions, and in part related to the liability and also to keep the human in the loop. And I know that Douglas, John, Yan, and Xuchun, you have also mentioned this. And then, so we focus mainly on the risks related to AI algorithm, but we have also risk related to humans, and we want to keep human in the loop. And so we have a question from Winston, for instance: how do we ensure that human supervision, human in the loop, are really effective? And so it is related also to the personal liability, Douglas. And so maybe we can have a brief description on this, how to keep human in the loop and human supervision, how to keep human in there.
Okay. Yeah, sure. I think this is something actually we also get feedback from the financial institutions that is very difficult. After we release the feed principle, because the second one is one of its responsibility, and most of the use cases in the financial institutions need to be human in the loop. It's something challenging, and to be honest, at this moment I don't have an answer. But one promising thing is this year, the phase 2 of the Veritas, we are working together with the consortium firms, the banks, and the AI firms. We are planning to develop like a checklist, a framework, a procedure, so that this could be a best practice to assure how we could keep human in the loop. Okay, and we are targeting to release this by the end of this year. So, yeah, just finger crossed. By that time, hopefully we should have a practical way to keep human in the loop, or to keep this responsibility. Yeah. Thank you.
Thank you. Maybe Yan or Douglas, or you want to add something? No.
Indeed, I think it's that's one of the key challenges. So I guess I mean, one of the now speaking very much also following on to what John said on the need to make sure that the procedures and processes are in place. I think one of the requirements actually in our proposal is indeed the requirement for adequate training. I think that is the let's say first step probably in this direction. But of course, it still doesn't eliminate let's say the scope for also human error. But I think it is still probably the step which many institutions have not really taken, and which is the first one. So I think that's what one needs to focus on, I guess, in this context.
Thank you. Maybe a question for you, Olivier. Yeah, it is related to the implementation of the European Commission regulation. Do you think that the ACPR will be in charge of implementing the future regulation of AI in finance, or it is related, or maybe the CNIL, or what?
No, I think it's a bit early to respond. So yes, I saw that the question in chat. I think the field of responsibilities of each authorities are quite clear. So if something is if we have a mission as financial supervisors, it will be the ACPR, and for the data protection regulation, it will be the CNIL. So, but maybe before speaking about who will be in charge, I think I would like maybe to come back to one question about the way regulators are currently building regulation through experimentation, co-construction, I would say, when you see what Singapore is currently doing. And then maybe what would be interesting for me is because we see that it's very difficult in these fields. I think you mentioned it in the first round of question. It's very difficult to draw a fixed line between what would be the intangible regulation and what is implementation and how you're going to implement it. Because when we say, well, we need a human in the loop, okay, that's a general principle, but how do you do it in practice? I think Résolution already said it's not obvious, it's not easy, and we really have to understand this. So do you think that experimentation may lead to changes in our approach, as it's already changed, for example, Résolution, your approach of some of your principles? And maybe the same question to Jan. I think you mentioned the word sandbox in the presentation. How do you think experimentation may change AI regulation? And the second question is, we are dealing, and there is a question there in the chat, we are dealing with a very fast evolving technology. So how do we do to have a regulation, to be in charge of a regulation without stopping technological development? So sorry, 2 questions for the price of one, but if you want to start, Résolution.
Sure. I think our Veritas approach like a sandbox approach, meaning 3 years ago, we have a guidance called FEAT. We see the challenge, which is difficult to implement the FEAT. Then we work together with the industry as a sandbox to develop a potential useful methodology. Okay, and after the methodology Veritas has been implemented and even further adopted in the FI, definitely we need to review the FEAT principle, and probably we need to adjust the FEAT principle. And another observation we find is for the AI governance, it is to at least for me, it's quite use case specific. Different use case probably need to use a different methodology. For example, our last year experience for the fairness to evaluate the credit risk scoring, the metrics probably it will be different to the fairness metrics to evaluate the customer marketing. And I assume, especially for the AI solution, the transparency, the more advanced AI solutions, such as a deep learning, versus maybe a more, explainable solution, such as a decision tree, or such even as a logistic regression, or even regression, the level or the difficulty, the complexity of transparency will also be different. And also thinking about risk-based approach. I think this all lead to we probably need to open our mind and do the sandbox way, so-called sandbox way, at least develop one first toolkit methodology and apply it in the real scenario. And then after that, we collect the real feedback and then review our principles again. Yeah, that's my 2 cents. Thank you.
Yeah, I would have 2 elements from our side actually to add to this. So I think one is that clearly this is for both the reasons you may need to adjust the principles and technology is fast developing in this area. For both reasons, actually, our proposal I think comes with relatively high level principles and definitions, or otherwise more process related. Sometimes they're more specific, but in those cases they are more process related, and in that sense, basically, should be applicable also with technological development. So certainly, when you put something, you hardwire something into a law, you better make sure that it is sufficiently open also actually for future development to allow it. And I think the second point is indeed on how actually you enable this experimentation in an area like finance, which is closely supervised, and that is where indeed the question of sandboxing comes into place. So I think on that, on our side, we very much support in various ways actually the idea that supervisors and firms actually work together to test certain approaches, and this goes for AI, but it also goes actually, by the way, for other innovations. I think within the EU, a number of member states are having different approaches on this. Some actually like to call it a sandbox, others like to call it differently. For me, that matters very little, as long as indeed there is a way or an opportunity for firms and supervisors actually to work together and test and learn. And from our side, I think we're supporting those both by actually trying to right now to again with the work with the supervisors to develop a cross-border testing framework, which would allow testing actually not only in one country but also across borders. I think that's an important element. And second, indeed, also to support those member states who do not yet have these kind of let's say approaches in place. So we have various programs from our DG reform actually where we work with member states to support them also financially, indeed, to put these kind of structures in place. And I am sure that as indeed AI is further developing in the financial sector, I think this will become an increasing focus of this work on sandboxing. But again, for me, in this area, it matters little how you call something. It matters most what is the substance and what's your openness and your willingness actually to work with the firms. And I think that's something we're trying to encourage. And then that's something that, however, indeed individual supervisors will also have to decide in the end what is in their specific situation, their regulatory system, actually the best way to ensure this.
I think there's an important point there, and that is to think about what are your regulatory objectives. Why are you regulating something? And take essentially a functional or an activity-based approach as opposed to focusing on an individual technology. And it's why we tend to focus more on the sort of managerial sort of responsibility as opposed to a sort of licensing framework where you're licensing specific types of projects or approaches. And this is, I think, as was pointed out earlier, if we think about the starting point, you really want to put in the foundation, something that makes whatever it is possible. So what is your approach to data? Is it a property-based approach? Is it a rights-based approach? Is it a public goods-based approach? And I think it's important that we are seeing different approaches to this fundamental basis of what is data in different places. But once you have your sort of foundation, then the question is, how does that get used? And that takes you into essentially your different regulatory objectives and concerns. Market integrity, fairness, financial stability, consumer protection, and the like.
I think one key point to bear in mind with these conversations about in the loop and the fast evolving nature of systems is how we think about benchmarking performance. So the expectation for human oversight is that humans will be able to understand the capacities and limitations of the system and then be able to make a judgment about the appropriateness of the deployment or the interpret an output in light of that to see whether there's something potentially amiss. But that presupposes that we have a benchmark in mind as to what constitutes a limitation. And let me give you an example. So if we think about potential for discrimination, which is one kind of hot topic with fundamental rights, we might say that the benchmark is perfection. That is, that we want the system to completely rule out any. An ideal system would rule out any any discrimination on the basis of protected categories. And so we would benchmark performance against that yardstick. So we would say this system is closer to that ideal than another. And that would be benchmarking against the goal. Another way of benchmarking would be say, well, let's benchmark against how a human might make the decision. And so recent research has shown that when AI is deployed in credit scoring, for example, there is some element of discrimination, but the discrimination is less than when humans make the decision. So actually, the AI, although it's not perfect, does better than humans. So if we'd used the benchmark of performance against perfection, we said it wasn't perfect and we didn't use AI, we might actually end up deploying getting worse outcomes by having humans make the decisions. And so an important question is, are we benchmarking against a perfect outcome? Are we benchmarking against the state of the art in technology, or are we benchmarking against a human decision maker? And there are three different benchmarks. And I think we should be encouraging decision makers to be familiar with the strengths and weaknesses of benchmarking approaches, as well as of just the technology itself.
I think that's a very interesting point, if I may, but I didn't know that there were such studies, because it would be very interesting sometimes to compare the human decision with the AI decision. I think this will, yes, it's a way of looking at the question, which is, I think, more practical.
Maybe I have questions regarding the end users, because we also talk about end users with John and Yan, Xuchun, and Douglas. And so I noted in your presentation, Yan, that you talk about ensuring appropriate degree of transparency and provide users with information on how to use the system, its capability and limitations. And maybe I have a question on this. Can you elaborate more on this? How can you ensure more transparency and provide the right information to the end users when they use AI systems in finance, for instance? Or do you have more ideas about that?
Well, I think the most imminent and obvious point is indeed, for example, when you have interaction with bots or other systems, indeed to have already the information that you're not interacting with a human being. I think that is already the first and foremost most important point. Apart from that, I think I agree, and that's probably what's behind your question, that this is, of course, a challenge. To what extent, actually, I mean, you cannot provide end users with 200 pages of system specifications, basically. So to what extent you can provide meaningful information, actually, on a system. I think that is, I think probably something which is also not unknown in finance, the need to kind of reduce complexity or to find a balance between end user information and, let's say, and complexity. And I think it's one of the areas in which one will have to kind of converge between firms and supervisors on a pragmatic solution, I think. So I think there will, I do not give you a clear, I think I gave you one example, but that's the obvious one, which all of us would know. For the rest, I more agree that this is a challenge to develop the right level, actually, of information. Maybe we also have, there some experience from Singapore. I don't know.
Yeah, it's a very tough question, and especially the transparency. I think at least at this moment, our goal is to bring the industry, academy, and also the AI firms together to build a toolkit which could evaluate the transparency of the AI systems. And then we will leave the user, either at the financial institutions or supervisors, to decide what level of transparency do they need and for what type of use cases. Because without a common agreed tool to measure the transparency, it may be for different stakeholders, maybe it's difficult to discuss how the AI system is transparent or not transparent. Yeah.
Thank you very much. Olivier, we are almost at the end of this very interesting webinar, so maybe we can conclude now, or?
Yeah, yes, I think we should conclude if there are no other questions. I don't know, do you want to say a word, David, or should I go on?
No, you can conclude. And I would like to thank again very much all the participants and the speakers. So it was very clear and very interesting. So thank you very much.
Yeah, I would also like to thank you all. I think it was very interesting to see all the perspective. I think that the perspective brought by Résolution with the experimentation, the implementation, this thinking about the implementation. I think it's very, very important. What Jan said about, of course, the general framework and the importance in Europe of the GDPR standards, it was, of course, enlightening and very important for us as European supervisors. And I think, John and Douglas, you brought also, all this perspective about compliance, responsibility. I was very sensitive to your point, Douglas, about the specificities of the sector, of the financial sectors, and the fact that we had to be careful about the outcome. And about your point, John, about product governance, I would say even I didn't raise the question because it's more technical question, but I think there is an important point for the financial sector regulation, because product governance is a quite recent regulation, and probably it will have to be adapted with the arrival of AI. So thank you very much for all this. I would maybe like to mention that as supervisors, we are really committed to participate to this thinking. We will organize in June in France a sort of hackathon, a tech experience about explainability of AI, because we think this is a very key issue for future guidelines, good practices, and understanding. And I think after this webinar, I'm even more convinced of the importance of the issue of explainability. And I would also mention that the interaction between the human in the loop question, the human and the algorithm are also a key issue that we must face together as supervisors and regulators in the coming years. So thank you very much for all this. I hope we have other opportunities to exchange on this, because this is just the beginning of the story, I would say. So thank you very much.
Thank you very much. Have a nice day.
Thanks, everyone.
Thank you very much. Bye-bye.
Bye.